During our working years, most of us tend to think of taxes in the present and focus on our income tax bracket and tax liability for the current filing year. But legislative decisions, the economic environment, and other forces beyond our control necessitate a more holistic saving and spending strategy that takes into account the lifestyle you're accustomed to today and the vision you have for retirement. Did you know taxes are a meaningful part of what you pay for in retirement? In fact, they are generally one of your biggest expenses. Many people assume they'll be in a lower bracket in retirement than during their working years. Should this hold true, then waiting to pay taxes until retirement and at a lower tax bracket might make sense. But often, when workers reach retirement age, they find that maintaining the lifestyle to which they've grown accustomed requires a similar amount of income as in prior years and results in a similar tax bracket as well. Many also make the mistake of thinking Social Security won't be taxed, when in fact, up to 85% of Social Security benefits may be taxable, depending on their income and filing status. And if they're building up retirement savings in a 401k, IRA, or other tax-deferred vehicle, they can expect to pay taxes on the principal, plus any gains when withdrawing from these accounts in retirement. After a boom of pandemic-related stimulus money, many Americans have been paying closer attention to national debt. In 2022, the U.S. national debt sits at over $30 trillion, which equals a debt per taxpayer of over $240,000. So when you consider that government spending consistently outpaces revenue, and that today's U.S. tax code, which expires in 2025, is based on artificially lower rates, and the hidden tax of high inflation is raising the tax burden in many states, the expectation is that taxes will increase in the not-so-distant future. It is realistic to think that the future tax environment will have a large impact on your tax bill in retirement. So, is it better to pay taxes now or later? Most people understand the compounding effect of interest and how money grows over time, but don't understand taxes operate the same way. You can choose to defer taxes and pay them later to save money in the current tax year. However, the more you defer, the more you may owe. While we're all required to pay our taxes, the good news is you have a choice as to when you pay them. And making the right choice can significantly impact the amount you pay during retirement. Now, let's see what happens when two people who are the same age and make the same income can both set aside the same amount of money from their paycheck. The difference is how they choose to withhold taxes and how those choices can affect a person's net worth over time. As illustrated here, the effect of delaying your tax liability can help you accumulate more assets upon retirement, but the subsequent impact of taxation and withdrawals can quickly outweigh the benefit of retiring with that larger sum, and could put you at greater risk of outliving your assets. Alternatively, a retirement income strategy which incorporates saving and tax spending during your working years can help you reduce the total amount you pay in taxes over your lifetime and potentially provide you with more money to live on during your retirement years. Tax-free strategies such as municipal bonds, Roth IRAs, and the cash value from permanent life insurance products can offer flexibility now and in the future.